Hi there, welcome to my channel. In this video, we are going to continue our discussion on basic consolidation, and as I promised in my previous video, we are going to consider specifically intra-group trading and its related issues and how to deal with intra-group trading and transfers in the consolidated financial statements. So thank you for sticking to my channel. If this is your first time on my channel, please subscribe to the channel and consider sharing the video with others so they can also benefit. And please like the video and leave your comments in the comment section so I know exactly what you are learning and what you would want to learn in the future. Thank you very much, and let's get back into business. Now, to start with, I want to lay the foundation again that group financial statements are prepared with the view that the group is seen as a single economic entity. And as a single economic entity, you cannot trade among yourself. You cannot trade with yourself and make profits or losses. So that is the basic idea, that's the basic principle when it comes to the preparation of consolidated financial statements. So there may be that instance where the group members may trade with themselves, and this gives rise to what we call intra-group trading. So as I said here, or as I have written here, when you have a parent and a subsidiary, they may trade with each other, and what will happen is that there may be issues, and the issues that may come up are what we'll be having current accounts in both the parent and then the subsidiary. By current accounts, we mean receivables and payables. All right, and then one of the companies may loan an amount to another. There may be dividend payments and then interest payments on loans that have been obtained from group members. All right, unrealized profit on sales of inventory. So you might sell an inventory to a group member that might be sold at a profit, and then at the end of the year that inventory will not be sold, so there will be an unrealized profit element on that unsold inventory. And then also there can be issues of non-current assets, where non-current assets might be sold or transferred to a group member. That will also give rise to unrealized profit because the transfer will be made at a cost plus profit. So that is the basic idea of this whole issue of intra-group trading. So what we are saying is that there may be various forms of intra-group trading. One is current accounts, that is a receivable in one, payable in another. That is usually as a result of transfer of goods or services. Then there might be loans from one to another. There might be dividend and interest or loan interest payments. There might be unrealized profit on sales of inventory, unrealized profit on sales of non-current assets. So what I'm going to do in this video is that I'm going to pick some of these, the most important or critical ones, and then we'll try and see how we are going to deal with those ones. The most common ones are the current accounts, loan, and then transfer of non-current assets, as well as unrealized profit on inventory. So we are going to look at those, and then we'll see how we are going to treat each and every one of them in the consolidated financial statements. So let's start with the current accounts. So as I said, the current account is talking about receivables and payables. So whenever you see in any question it said that there is a balance on the current account, note that we are referring to the receivables in one account or in one entity, and then the payables in another entity. Right, now these are amounts owing within the group rather than those outside the group, and therefore must not appear in the consolidated financial statements. Why? Because the group is a single economic entity. That's the reason. So they are therefore cancelled against each other on consolidation by deducting from the relevant lines on the statement of financial position. So the relevant lines in this case, we are talking about receivables and payables. Okay, now what do we have here? We have there may come to a time where the amounts in the receivables and payables, or in other words the current account, might not agree with each other. So the parent sells goods of 1,000 to the parent. So let me put parent here, and then so if the parent sells goods to the subsidiary, this is a subsidiary, the subsidiary is also supposed to write 1,000 in their books, and the parent is going to record a receivable of 1,000, and then the subsidiary, who is the one buying, will record a payable. On consolidation or at the reporting date, the amounts might not agree, and a possible reason or two possible reasons might be cash in transit or goods in transit. Cash in transit or goods in transit, those are the two major reasons that might account for the current accounts not agreeing with each other. So what do we mean by cash in transit? The subsidiary might send cash to the parent in payment for the goods, in part payment of the goods. So assuming at the reporting date, the subsidiary transfers say $500 to the parent, but the parent has not received the amount yet. So what this means is that the subsidiary, because it has transferred 500 out of the 1,000, it will record 500 at the year end, but the parent will still be having 1,000 in his or in their accounts. So what is happening is that there is this transfer of cash that has not reached the parents yet at the reporting date, but it has been transferred by the subsidiary. This is what we call cash in transit. And the relevant adjustment we do is that we treat the cash in transit as though it has been received by the parents, in this case the parents, as though it has been received by the entity to which it has been transferred. So what do? We debit the cash, and then we credit receivables. We will debit cash and then we will credit receivables. I don't know if you get it. So the parent is expecting 500 from the subsidiary. So what do? We treat the 500 as though it has been received by the parent. So we will debit the cash in the parent's account, which now is the consolidation entry, and then we are going to credit his receivables. We are going to credit his receivables so that at the end of the day, the amount is going to balance. All right, so that is it. Then goods in transit is the same thing. Instead of cash, this one you have transferred goods worth 500 to the parent. Maybe the goods were 40, so you have transferred it to the parent at the year end, but the parent has not yet received it. So using the same logic, we are going to debit the parent account, that is the inventory, and then we are going to credit payables. Alright, so that is the entries that we have for cash in transit and then goods in transit. We are going to put this into practice, and then we will see exactly how it will go. So now let's talk about the unrealized profit element. When one group entity sells goods to another, a number of adjustments may be needed. Number one, the current accounts must be cancelled, as we have already seen, or as we just talked about. And then where the goods are still held by a group entity, any unrealized profit must be cancelled. So whenever an inventory remains in stores by the end of the year, and that inventory was as a result of an intra-group trading, what we do is that we calculate the unrealized profit element on that outstanding inventory in stores, and then we eliminate it from the consolidated figures. That's what we do. Now, inventory must be included at cost to the group. So any form of profit on the cost, or any amount of profit on the cost, must be completely removed, because you cannot trade on within yourselves. Okay, that is the original cost to the entity must always be included in the consolidated financial statements, not at any profit. So let me give you this scenario. Assuming that parent P and then its subsidiary S. For a parent P and then the subsidiary S. Alright. So if the parent, if P purchased goods for $1,000, alright, and then sells these goods, sells them to S at 1,200, then P will record a profit of $200. P will record a profit of $200 in its account, or in its individual financial statements. If these goods were still held in inventory, if the goods that have been S are still being held in the inventory of S at the end of the financial year, then the statement of financial position of S would include closing inventory at a cost of 1,200, which outside of the group is costing 1,000. Okay, so you see, this is according to the single entity concept. The single entity concept says that profit, we should only report external profits, external assets, as well as external liabilities. So these are external costs. External costs must be the only thing that are going to be recorded in the financial statements. So the inter-group transaction in which there is a profit of 200 in the parent's financial statements must be eliminated on consolidation, because that is what occurred within the group. So the fundamental issue here is that the parent has a profit that is unrealized. So this profit is unrealized. Why? Because the inventories sold to the subsidiary is still unsold at the end of the year. So this profit element here is unrealized. The profit will only be realized by the group when it is sold to a third party customer. When the customer is a third party, that is when we'll record this profit as realized. Alright, so right now the profit is what? Unrealized. And so the value in S's inventory is not the cost to the group. This value 1,200 is not the cost to the group. Rather, the cost is this 1,000 which has been purchased from outside the group. So at the end of the day, it is just this amount that we want to see in the consolidated financial statements. So that is the issue of unrealized profit. Now there is a way of calculating this unrealized profit. So as I was saying, the inventory is must be held in inventory at the year end. So what we do is that first we determine the value of the closing inventory held by an individual entity which has been purchased from another entity within the group. So there must be inventory remaining, and that inventory must have been bought within the group. Okay. Then secondly, we use markup or margin to calculate the value of profits included within the closing inventory. You should be familiar with markup or margin. Markup is the profit on cost, whilst margin is a profit on sales. That is the summary of the entire thing. Markup is the profit on cost, and margin is a profit on sales. So when margin is applied on sales, we apply the percentage directly on the sales to get our profit element. But where margin is applied on cost, then the margin has to be converted into markup, because markup goes with cost, margin goes with sales. So we have to convert the margin into markup if the margin is applied on cost for us to get the profit element. The same way, if the markup is applied on sales, then you have to convert the markup into margin to be able to determine the value of our profit. You should revise your markup and your margin for you to do this very well. It's not difficult. It's never difficult. That's why I say I give you a summary of what markup and margin is. Margin is on sales, markup is on cost. So when markup is given on sales, you have to convert it into margin. All right. So that is it. And then you make the necessary adjustments. So what adjustments do you have to make? The adjustments you make depend on who sells to who. The adjustments now that you have to make depends on who sells to who. If the seller is the parent, or if the parent sells to the subsidiary, the profit element is included in the parent's retained earnings and belongs to the group. So what you do is that retained earnings is a credit balance. So to be able to reduce the unrealized profit element from group retained earnings, we debit it. We debit the group retained earnings, and then since inventory reducing, we will credit our inventory, because inventory has a debit balance. So we'll credit our inventory. All right, and we do this with the deduction of the inventory from the inventory. We do this on the face of the statement of financial position. But the group retained earnings, as I've already covered, this is workings 5. So we are going to subtract it from our group retained earnings, which is workings 5. That is if the seller is the parent. If the seller is the subsidiary, then we do the adjustments in the net assets schedule of the subsidiary. We do the adjustments in the net asset schedule of the subsidiary, and what we do is that the profit element is included in the subsidiary's retained earnings, and we know that this retained earnings is part of the net assets of the subsidiary and relates to the group partly, and then also partly to non-controlling interests, because we are going to apportion the retained earnings of the subsidiary at the end of the period to the group as well as to non-controlling interest. So what we do is that we are going to debit the subsidiary's retained earnings, and that is going to reduce the profit elements or the retained earnings in the net asset schedule. And then we are going to credit inventory as usual by deducting it on the face of the statement of financial position. So by deducting or by adjusting the retained earnings of the subsidiary in the net asset schedule of the subsidiary, the provision for unrealized profit, which is usually shortened as PUP, will automatically be shared between the parent and the NCI, or the non-controlling interest. So this is how we deal with intra-group transactions. Now the other ones are adjusted. They do not have this one way or this hard rule of going about them. So we will know how to adjust them depending on the situation. So what you have to know is that any that occurs between the parent and its subsidiary or subsidiaries. The subsidiaries can be one up to two subsidiaries. So any transaction that occurs within the group must be eliminated on consolidation. So this is how we adjust for intra-group elements. For the transfer of non-current assets, they are also done in similar way, just that the non-current assets are not held for sale as we have with inventory. They are not held for sale. Hence, we are going to adjust the depreciation element, which might have reduced your profits, or which we call excess depreciation, and so might have reduced your profits more than necessary. So what we do is that we add that back. We are going to add any excess depreciation back to our profits. We are going to take a question which I've captioned here, putting it all together. So I have a question here that we are going to solve in our next video. So stay tuned and join me in the next video as we look at how to put all these in practice. Thank you very much for watching my video. I'm very grateful for your time. Please subscribe to the channel and share with others so they can also benefit. See you in the next video. Until then, say bye.